Hey everyone, welcome back. Stacker here. In today's numismatic news and information for the 13th day of August 2023, I'm going to welcome you over to moneymetals.com so I can show you what the live spot price is end of the week. But before that, I'd like to thank all of our channel members. Really do appreciate all your support. You know who you are. Really dig it. Now, over here to moneymetals.com. Gold ended the week at 1924.5, silver at 22.91, platinum at 931.95, and palladium at 13.61 even. Steven, you're looking at an in-stock American Silver Eagle whose premium is 10.49. And I think it'd go a long way to reducing that premium if we saw more sales here for those gold and silver Eagles. That would be something. Now, huge article here from Numismatic News written by Patrick Heller, dated August 10th. That was just 3 days ago, 2023. Is the silver supply squeeze coming? I think it is. Now, there's another article. I may not have time, but I will leave a link in the description here. This is from Shift Gold. Comex now has 28 paper claims for each physical ounce of registered silver. Yeah, there it is. All hands on deck. Here we go. The New York Comex serves investors and speculators who want to trade in the price of commodity, but have no interest in handling the physical items. I don't know if I'd be that person. The most widely traded gold futures contract is for a 100-ounce ingot. The highest volume silver contract futures is 5,000 ounces, consisting of 5 1,000-ounce ingots. Now, folks, there's a question that this industry has is, well, if you don't hold it, does that mean you own it? I don't know. I think that's a question for you to ask. It says here, those who are only trading on the price normally close out their positions before contract maturity. They have the option to close out their position altogether, or if they want to remain in the market, they place their soon-to-expire contract with another one that matures further into the future. If held to maturity, the party that owns alongside of a futures contract can ask for delivery of the underlying physical asset. The party on the short side of this contract has 4 options on how they can satisfy their obligation to deliver, okay? Normally, the least expensive option would be to deliver the physical assets from a Comex bonded warehouse. Alternatively, if the counterparty will accept it, the short seller can make a cash settlement. Or if both parties agree, shares of an exchange-traded fund, ETF, for that amount of the commodity plus some cash. Finally, in what used to be considered only an emergency option, a maturing contract called for delivery can be settled by exchange for physical. I like it. Using this alternative in precious metals markets, the short seller pays some cash plus delivers a London Bullion Market Association contract for delivery of the same quantity of the metal. That's LBMA, folks. Now, because in theory, most trading of commodities on the Comex will never be settled in physical delivery, the Comex only keeps inventories in its warehouses that cover just a fraction of open futures contracts. Yes, that's kind of scary. With only fractional coverage of open futures contracts, if there were a sudden surge in maturing contracts called for delivery, you could have a market supply squeeze that could lead to a soaring commodity price. And I think that's what they're making the argument here. And I think we will see this. I really do. Is it possible that a supply squeeze could hit the Comex silver market in the next few weeks? Oh, what? That's sooner than later. Over the past few decades, that's a long time, right? That's many years, there has generally been a shortage of newly mined and recycled silver supplies to cover industrial and investment demand. Right now, Chinese manufacturers are having difficulty finding sufficient silver inventories to continue production of solar panels and other goods. What are those other goods, I'd like to know? Silver jewelry, perhaps? The current active month of Comex silver trading is in transition from September 2023 to December 2023. Many investors are closing out the September contracts that will expire before the end of August. Now that's just like a week, 2 weeks, 2.5 weeks away. To replace them with December or further out contracts. But something strange is happening. Let's get down to it. As of last Friday, there were still almost 95,000 September contracts still open, representing 474 million ounces of silver. What? Wow, this is about 40,000 more contracts, all right, representing 200 million ounces of silver, higher than typical for this close to the contract expiration date. Something is up, definitely. Is it possible that one or more parties are seeking to acquire physical silver by holding a long position in these excess silver contracts with the intentions to demand delivery upon maturity? Remember, that was the emergency option out of those 4? That's something. I don't know, period. There is at least one rumor that it is possible that some Chinese manufacturers may be going this route to acquire silver that they are unable to obtain through standard channels. And I think China's going through a deflationary stage right now, so we'll find out what's going on here. If this were to occur, could the Comex cover? And in one short, simple sentence, no, it could not. Here we go. As of last Friday, the Comex only had 31.7 million ounces of registered silver in its bonded warehouses that are committed to deliver against contracts called for delivery. There were another 240 million ounces of eligible silver in inventories, Comex warehouses, but these are not available to deliver against maturing futures contracts unless the owners are willing to have them reclassified to being registered inventories. Now, as it stands, there exists the possibility of a severe silver market squeeze before the end of August. Folks, that's like 2.5 weeks away or less. If this comes to pass, what could happen to the price of silver? Well, I think you know. I think your instincts are right. For guidance, let's look back at what happened 25 years ago. Now, it says here Warren Buffett's 1998 silver supply squeeze. In the middle of 1997, the price of silver was around $4.50. Billionaire Warren Buffett judged that this was a bargain price. His Berkshire Hathaway began buying Comex silver contracts with a maturity of March 1998. Remember that. Now, March 98, okay? These purchases, which eventually totaled 129 million ounces, were spread out so as to minimize the risk that the price could rise against him and his companies. I think that's wise. Now, in February 1998, he announced that instead of rolling over his maturing contracts into the future, he wanted physical delivery of the metal upon contract maturity. And I think that this is the article is going to state that, hey, this is what's going to happen. This could happen anyway. Now, it says there were simply not sufficient Comex silver inventories to cover all of these deliveries for the Buffett. Short sellers were scrambling to find any available physical silver they could acquire to be able to deliver to Berkshire Hathaway. That could happen again real soon, folks. The price of silver peaked around $7.30 by mid-February, a jump of more than 60% from mid-1997. Then Buffett let the short sellers off the hook. He would accept delayed delivery of the physical silver if the short sellers would make it worthwhile to him. What does that even mean? While I'd never seen an official statement, the rumor was that the short sellers had to pay Berkshire Hathaway 50 cents per ounce to get the delivery extension. Wow. That's called negotiations went well. Now, the Berkshire Hathaway silver inventories eventually were deposited into a silver exchange traded fund, where the company reported that it had liquidated this entire position by the end of 2006. Interesting. Once the silver supply squeeze subsided, silver's price slid back down mostly to under $6 and even below $5 for the next few years. The silver price did not exceed its mid-February 1998 peak until early February 2004. I don't know what it's February 2004, but it's early 2004. Now, this time will be different, it says, or would be. If there really does develop a silver supply squeeze in the market, it would almost certainly result in a quick jump in the price. However, unlike what happened 25 years ago, don't expect to see much fallback in the price. And look, folks, what's different now, technologically speaking, than 25 years ago? Was there AI making decisions for traders? Were there price triggers for trades? Maybe not so much, not for most people. It says here, don't expect to see much fallback in the price. That's because there would be a major difference in this year's supply squeeze and what happened with Berkshire Hathaway silver. 25 years ago, the Berkshire Hathaway inventory purchases continued to represent supply that could be sold back onto the market. Now, if a silver squeeze happens soon to provide inventory to manufacturers, this will not be available for resale onto the market. Possible silver supply squeeze would not occur in a vacuum. Here we go. This is really interesting. If it turns out there is a major attempt to acquire silver for manufacturing purposes rather than for investment speculation, well, this will not happen in a vacuum. Like, think about it. The manufacturing gets used up. It just doesn't sit in somebody's vault or an ETF. Other parties who are concerned about rising silver prices also boosting the price of gold will be watching and taking action. Isn't that interesting? So what happens to one affects the other. The U.S. government would have the most to lose from rising silver and gold prices, as the U.S. dollar would lose value. So maybe they have a vested interest in keeping the price down. The result would be higher interest costs on U.S. government debt, among a wide range of other negative consequences. That's right. So, if there really was a prospect of a major silver supply squeeze, how would the feds try to stop it? Think about that. They're going to try and stop it because it's in their best interest. First, it would put pressure on the primary trading partners of the Federal Reserve Bank of New York, allied central banks, and the International Monetary Fund, that's the IMF, and the Bank for International Settlements to go to great lengths to suppress gold and silver prices before the supply squeeze hit. It is possible that this is happening right now. What? Now, folks, is that manipulation? Or is that just them taking action, being defensive? That's up for you to decide. Next, it would coordinate with J.P. Morgan Chase to leverage potentially hundreds of millions of ounces in silver inventories in the bank's vaults, some of it owned by the bank and some of it owned by customers. Now, if necessary, it might offer a fee to temporarily borrow physical silver to meet the demand to deliver the metal, maybe 50 cents an ounce. In most extreme circumstances, silver might be delivered even without permission from the current owners to do so. Hey! Wow! Should a potential supply squeeze be averted over the next few weeks, that would not have the same impact on silver's price as happened 25 years ago. This time around, the physical silver would mostly need to be returned. That means there would be a continuing shortage of physical silver on the market. Yes, indeed. Also, as manufacturers and investors come to realize just what is happening in the silver market, they will also ramp up the demand to acquire physical metal, folks. And that's how it happens. When the price is going up, people are buying. When the price is going down, people don't buy as much. It's really an interesting psychology. Now, here's the summary. There may or may not be a spike in silver price in the next few weeks. It could be that last Friday's anomaly of an extra 40,000 open silver contracts representing 200 million ounces could just be an unusual timing problem for parties that own them. But even if a physical silver supply squeeze does not develop over the next few weeks, the shortage of silver inventories to meet manufacturing demand in China and elsewhere around the world would still put upward pressure on silver's future price. This development would also lead to greater demand for gold, pushing up that price as well. Isn't that something, folks? What do you think? Are we going to be having a silver squeeze soon? And I did want to mention this one as well. This is Shift Gold. Comex now has 28 paper claims for each physical ounce of registered silver. Look at all those hands. Just can't wait to grab some of that silver. That is interesting, and I will leave a link in the description for this particular article as well. It's good stuff, folks. Now to the plus ones. Bam! This is Psalm 69:16. Draw near to my soul, redeem it. Because of my foes, deliver me. And I think what that means to me is that rescue me so that my enemies should not say that you are powerless. Because if they do say that, well, would they even join you on your side? Or would they be like, yeah, that guy's just, see, told you, and they'd be scoffers, right? So, yeah, I don't think he wants any more scoffers. There's already plenty of those around. Now, let's go to this song. It's like 4 days old. This is 99.9. This is some dude named Oliver Anthony, Richmond, north of Richmond. It's a really interesting song. I'm telling you, it's got like 5.3 million views in 4 days. I'd say that's going viral. What do you think? Now, folks, I want to thank you all for watching. Thanks for dropping by. Don't forget to hit that like button. And if you did like what you hear and see, please sub the channel. It's free. And, yeah, have a good rest of your weekend, folks. Stacker out.